What's up, everyone? Welcome to Young Money Real Estate. I'm Jose, your host, and this podcast is about learning real estate in real time alongside me. Today's guest is someone who made work optional in 3 to 5 years, all thanks to real estate. Keith Blackborg and his wife bought their first rental and flip on their first day of real estate, built enough passive income to quit their jobs, then traveled the world for 3 years, all thanks to real estate. Today, he talks about how to become work optional in 3 to 5 years, what he would do with 50K in today's market, tax strategies that a lot of investors miss, and much more. Now, with that being said, let's dive straight to it. I appreciate it.
Of course.
So, let's just get straight to it. Could you
Let's do
just
it.
run me down and tell me what do you do these days for work?
I help guide a self-directed community of millionaires. So where financial advisors want to do it for you and charge for AUM, I show people how to catch the fish, how to run your own micro family office. So our medium net worth is about 6 million, or as some of my larger friends say, the poor millionaires. Um, So most of our clients are in that 7 to 8 figure range, and then we also manage a family office that's a little higher number.
That's good. It's nice. So, you started out as a CPA. What made you decide to jump into real estate?
I've always had an entrepreneurial streak. My secret weapon or competitive advantage as a CPA was having a personality. Not many people did and do. We had just moved to Dallas and heard a man, Robert Kiyosaki, speak in the Dallas area, and we thought that's our thing. He was selling $30,000 coaching programs, and I think I was 24 at the time, did not have $30,000. So we found a local organization called Lifestyles Unlimited, and they gave us a lot of what we needed to get started.
And so, how did you get started?
So we went to a workshop. We were cheap and spent $500 on the initial program. And boy, it was my girlfriend at the time. We got married just a year later, and we were together. We said, we can figure this out. So we went for the basic bare minimum program. We went in, saw some other young people around our age. I 24, 25, and said, let's do our own mastermind group. A mastermind group's the fastest way to figure this out. And we were all just 20 something figuring this thing out. We met, I think it was every other week throughout that, and it really helped us grow. So we started in August of 2010, bought in a rental and a flip on the same day because we couldn't do one. The idea was that the flip would help pay for the rental. We would take the cash flow and reinvest it in our next rental and give us our proceeds back.
So, what was the process like when you bought that rental and the flip? How did you analyze the market to make sure it was a good property to purchase?
Uh, we looked at other rental comps in the neighborhood. If you're going to be a flipper or rental house, just getting good at that is really helpful. These days, Zillow is so much better than it was 15 years ago. Um, and so having an idea of what it's worth, being able to run those comps, if you've got access to some sort of tool, that's phenomenal. There's a bunch out there. But we would get an idea of the value. We could see what we were paying for it. We'd do an estimate on the rehab price. My wife, who speaks Spanish, was phenomenal at finding way better prices along the way. And that helped us get good at the numbers. I ran the spreadsheet and we kind of thought, looks close enough. We've got some upside here, and we pulled the trigger.
You know, how did you find people to move into those properties? Would you just list them on like Zillow?
Yeah, Zillow was one option. Occasionally we did MLS. That was kind of a last minute option. Many times we'd stick a sign out in front of the yard. We try and schedule a single day with multiple showings in an hour. Part of it, other renters see each other and they know there's only one property, and we tell people that we'll give them a call, and that overall worked really well for us.
So, like when you look back to your early real estate days, was there anything you did that really gave you momentum to take you to that next level?
Part of it was there's a lot of people I meet who go to all these real estate boot camps and they're quote unquote tire kickers, meaning that they never do anything. And so there's an element of educating yourself, but at some point you've got to take action. I learned more through those first two deals than I ever could have in any number of seminars or education. Practical, hands on, real life experience of figuring things out was the single biggest factor in realizing we could do this. And then, secondly, having the mastermind group of other friends that we met that were also trying to do this meant that we were all bouncing ideas off of each other, and there was social proof that this worked. And so within 5-ish years, every one of us that wanted to be out of a job, which was about 75-80% of us, had quit their job and started their own business.
So when you reached the point where you actually became a millionaire, what was that? What did that look like behind the scenes? What did it feel like?
You know what? You think it's going to be this giant deal, like, oh my gosh, look at what I've built. In the moment, you're like, yes, I know I've had some success, but it many times just feels like more work. As unsatisfying as that might sound, was I actually had trouble slowing down. So the big reason why we started was to reach work optional or financial freedom. And I hit 30, had gone over a million, and my big number to start with was I just wanted $10,000 a month of passive income. And we had hit that, gone beyond that. And my wife was like, well, we have enough. Let's go travel. Let's do stuff. And I was like, no, I want to keep going. I still had the CPA firm and I had all that. And I also felt important with all the other work I was doing. So there actually had to be this come to Jesus moment of why am I building this? What is this for? And had to take a step back and enjoy it. So, and actually we had an exit 2016, 2017, sold out of a lot of the residential stuff and some commercial stuff we had bought, and intentionally took a portion of that and said, we're going to go enjoy it. And so we spent 3 years traveling the world before we had our first kid.
And with all that work, I'm guessing it had to be so much work. Was there ever a point where you thought about quitting? And if so, what kept you going?
It was a lot of work, and there was a reason why we slowed down. Anybody who tries to tell you that rentals are passive hasn't owned a lot of rentals. They do require work, they do require time, but if I'm thinking about wealth as the business when you're first starting out, you've got your job where you're earning income. And then you want to systematically either start a business or take that job income and put it into assets. It's assets, not income, that make you wealthy. And real estate is a fantastic vehicle for that. And I can speak more to that. And then in time, you're also like you're looking at your lifestyle cost and what you're doing. Like, so if I think of it, there's your three pillars of your wealth business: your income, your wealth or your assets, and your lifestyle cost. And managing all of those cohesively is what really gets you ahead.
So let's say someone has 50K to invest in real estate. What would you do with it?
Oh man. And I want to say I benefit. I'd like to think I was brilliant. I was also lucky getting started in real estate in 2010. If I were getting started now, it might be tougher. And so some of it is I know in the Dallas area I could buy houses for $30,000 to $50,000. Those same houses now are trading over $200,000, and so it's a different market. I would try something. I would look at what the market is and see where you think the best opportunity is. You can still make money in flips and rentals and Airbnbs or self storage. There's a ton of things out there. Duplexes. If it were me starting off, I would probably start with a flip, or if you don't have 50,000, maybe a wholesale deal, so that you're learning how to acquire and find deals and then build up from there.
What about house hacking? I saw in one of your LinkedIn posts that you mentioned house hacking, and especially for someone like me, convincing my parents to help pay for a down payment and then rent out the other rooms. What do you
I
think?
think I think it's brilliant. If your parents are willing to help out, that is one of my favorite ways frankly, as a parent, to give your kids some real life experience. And my kids are like 3 and 6, so I'm 40 years old. I know, anyways. Uh, all that to say, it's a great way to get some real world experience and see if you like the rental income. And the whole thing is so many young people focus on the job and having fun. If you spend just a little bit of time on the house stuff, we probably spent 10 to 20 hours a week on the real estate stuff, but that was the bigger impact on our wealth, way more so than any job could have. And so as that grows, you might even start to find jobs are less and less important, and you can gradually scale up in doing more with the stuff. But in your early years, you don't typically have kids. You've got more time freedom. This is your golden time to really make a big difference, a big punch, and jumpstart your wealth. And if you put a little effort, you're going to rise faster. Compounding is going to mean that even if you're done with it and you put it, like, even if you just do the S&P 500 and you're earning 8% plus, you'll be set for life by the time you hit retirement. With a little bit more smart planning, you could easily reach retirement in 10, 20 years. The simplest way, most reliable way to reach work optional: buy one rental house a year for 20 years and just pay them down. Maybe not the smartest, but it's the most reliable way to make a big impact and ensure that you're set within 20 years.
I know you talk about a lot of like tax opportunities to save money. What's a tax move most of the new investors just completely miss?
Here's one. If you're willing to move a little bit, you may have heard that you can buy a primary residence. And if you've lived there 2 years, you can exclude the capital gains up to $500,000 from taxation. So one thing my wife and I would do is we'd move into a house. In some ways, it was a flip. Sometimes there are certain houses that you have to be like a homeowner occupant to get, especially if they're selling on HUD. And so we would buy these houses, do a homeowner occupant. We'd live there for a couple years, and then we'd sell it. So running this out, let's say you start with like $150,000 house. You improve it, and now it's now worth $250 a couple years later. Now you take that $250 and that maybe $100,000 gain or $50,000 gain, you buy a bigger house. You buy the $500,000 house. A couple of years later, you sell it. Later, you buy $1 million house. Maybe you have $500,000 into it, and after you've improved it's worth $1 million. You sell it, take your $500,000 capital gain, and buy a new house loan free. That's another way to pay it down. There's no taxation, and not so easy to do with kiddos. But especially when you're young, it's a great strategy to kind of house hack your way up. And if you want to do loan free, if you see high interest rates, that's a way to do it.
So, did you do all of this yourself, or did you have
Yes.
people helping you? You really?
My wife and I, well, to be clear, we use contractors and things along the way, but it's not like we had employees in this business. In the commercial real estate, we had employees.
So, let's say you want to buy a flip. Did you look and inspect the property yourself, see what's wrong with it, or did
Yes.
you have a professional come in?
In the beginning, we might have used an inspector, or we would walk it with 1 to 3 contractors and to really get a few opinions. Sometimes we burned a couple relationships where we didn't use those contractors after the fact, but there's so many out there that sounds like a terrible advice. But in time, we got really comfortable like walking it ourselves. Me being the accountant, I tended to be like more the numbers guy, and my wife was more the hands-on person. So we'd like be going through Home Depot. She's like, "Hi, Bill. Hi, Tom," and I'm like pushing the cart behind her. Kind of embarrassing, but she was really good at it. All that to say, we as a team got really good at estimating our own numbers. And we might be off a little bit, but we were always within $5,000, and we were able to be quick and really dial in our systems. And that just comes with experience.
And as you got more into the real estate and you grew your portfolio, did you eventually get your own team around you?
Never on the rental side personally. We just felt like we could do it. On the commercial side, yes. One of the other things I did along the way is I served as director of acquisitions for a hedge fund. and bought 875 houses for them in 9 months, mostly through auction. That was quite the ride. There, we definitely needed a team, and it took time to build that team. And there were some speed bumps for us, but there were some others that totally failed at it and did not do it well.
So when you're, say, commercial real estate and you want to do a partnership deal, how do you make sure it's a win-win on both sides?
You mean like limited partnerships or like a joint venture?
Joint venture.
So a lot of partnerships end badly. As a CPA, I've seen like every partnership ends in death or divorce. And so you got to pre-plan your prenup with all of the with any partnership. And so often when I was young, I went through a multiple partnerships with friends, and none of them were particularly nasty. But it's easy to say that let's split things 50-50 because that seems fair. In my case, you never know who the boss is. So when you disagree, how do you settle that? So I would rather there be a 51-49% partnership, even if I'm the 49% partnership. That way we clearly know who has the final say. If we're buying a commercial real estate deal, usually you have people's roles. Whoever is, like, just like anything, whoever's on the sales side or acquisition side, they control the deal and have the best opportunity for setting the terms. So usually if somebody can find a fantastic investment and then they're sharing it with a group of others, they're in a more favorable negotiating position to ask for more. And so if I were to ever focus on one thing, it would be on the acquisition side. Secondly, the management side. You can hire a third-party property management at any time for any of these things, but their goals aren't aligned with you. Their goal is, if they're charging 10% of like all revenue, their goal is to get as many properties as possible, do 10%, and then they'll charge retail prices on expenses because they don't make that much more by optimizing expenses. You as the owner prioritize net income, you care more about the prices. And so to an extent, doing it yourself is more valuable. You can also, if you're going to get into commercial real estate, there's all sorts of people out that will charge you $50,000, $100,000 to go through their coaching course to go learn how to do commercial real estate. The best way we've learned is, like with our first hotel deal, we found a management company that was willing to show us and to teach us how to do it. So once we had it under contract, we found the management company that said, hey, we're willing to let you learn alongside of you. My wife served as the general manager for the first 3 months of the hotel. And she was in that role, in that job, but she learned that business. And effect, the management company was the coach, and the whole management fees were still less than, I want to say it was like $30,000 to $40,000 for that first year, way less than the coach. And we got all the back end support that was along with that. And all that coaching fee was paid directly by the hotel. And then we were able to go out and raise money from other limited partners to help fund that. Does that answer?
Yeah. So you've built like a system now where your money basically works for you with the hotels
Yes.
and apartments. What does that machine look like? What does your money do when you're sleeping?
Oh man. There's always it's always working. My favorite thing about real estate is that it's it's an asset and a business together. If it's just a business like a software company, that can go away and the value can evaporate. Real estate has something tangible associated with it, and so the chances of it going to zero is dramatically less, which is why there are more millionaires made reliably through real estate than anything else. And that's why it's my favorite asset class. And so if you, for me, that initially started with flips, it meant going to rentals, and then meant picking some form of commercial real estate in today's market, industrial, AI centers, could be cold storage for groceries. Like there's all sorts of niches. Find something that not a lot of other people are doing and grow up into it, even if it means working for somebody else to get the experience. Because when you're young, people are willing to hire you, and they're willing to pay you to learn. And that's like my favorite way to grow. Beyond that, then you're likely, like most family offices that do real estate, start their own management company. So if you're going to optimize these well and be these long term, learning the actual operations yourself, willing to get your hands dirty, means being involved in management. You can be hands off and you can be passive, but it's likely going to hurt you in your results. Also, pay the people well that are looking at this stuff, because that's going to help you get better results. And so that machine really needs to get built over time, and you need to do it with community. Whether that's a mastermind group you set up, or you join somebody's community, and possibly having a coach that really knows that particular niche is critical in working through issues and accelerating your growth.
So how do you pick people that you like want to invest with? Because when you're putting serious money into a deal, like what green or red flags do you look for in people?
Oh, there's quite a few. So let me back up and say this is how we vet things. We look at how billionaire family offices manage and invest as an example for how we manage as a community of self-directed millionaires. So one of the things that the family offices will do is they have an investment committee. Any one person individually would get swayed. There's different personality types that resonate with one person or the other. And there is safety with a multitude of counselors. So, for example, if we're vetting an oil and gas deal, we've got the chief drill officer of a publicly traded company that will weigh in, and then we'll hire 2 outside oil and gas engineers. If we're looking at a real estate deal, we've got guys in all sorts of niches, guy that has 30, 40 self-storage facilities, others that have billion-dollar multifamily portfolios. They've got unique experience to help us vet those. When we're vetting, there's 3 things that we look at. We look at the asset, we look at the team, and we look at the documents. Any one of those can have serious issues that make it an issue. So first, we want to look at the team. Do they have a track record? I'm not investing with anybody who's been doing it less than 5 years. That's going to sound harsh because a lot of people are trying to start, but I've made enough early risks to see that people who have been doing it less than 5 years make elementary mistakes, and at least half the people that have been doing it less than 5 years won't be around 5 years from now. So I want long-term track holders. I want syndicators that own their management company. If they do third-party property management, the incentives aren't aligned. They're often almost punching lottery tickets where they want to raise as much money as possible across as many deals as possible. And if a few fail, they don't really care because they've got more frequency of deals. I'd rather somebody has fewer deals who really optimizes them well. The relationship matters. So once somebody's in the door with me and we do one deal and we like it, we start doing more and we build upon that trust. And often there are people now that I've known since 2010 that we've done repeat deals with because we built up that trust and they get results. And so it's much harder for somebody new to the game to get into this. The asset, even if we love the team, we will look at the asset and decide if that's still a good fit. Sometimes they overlook something. And if we're looking at a deal, we're looking at a team and it's not like a hell yes, I'm all excited for it. It's a hell no. So things really need to align. At this point, when you're first starting out, you're like, I got to find something, opportunity. But once you're in the fast lane with multiple deal flows, I get so many deals that hit my inbox every day, every week. It's like, what am I going to say yes to? What am I actually going to give my attention to? And so where things align, where things are easy, and I've previously worked with them, then I'm likely to really go further with them. Lastly, the documents, especially like oil and gas deals, I would say like a good 80% of them are either scams or will never make money. Anybody who leads with tax benefits as the primary reason why you should invest with them, I don't invest based on marketing gimmicks. So I'm going to focus on things where 1, they want preservation of capital. 2, I want a strong investment return. And then 3, there's any ancillary benefits like tax deductions and other things like that. And then what's their structure? Are they making a big acquisition fee? Are they making a big sales fee? There's all sorts of fees that can be buried in these private placement memorandums or PPMs. It's the legal documents that you go through whenever you're getting into a private syndication. We now have a prompt that we will run that all through like ChatGPT. So give me all the fees, all the ways a syndicator makes money, all of that. And that really helps us dial in, like, do they make money when we make money, or are there other ways that they can skim off the top? And what I'm really looking for is a win-win, that we're both making money when the deal succeeds.
And so you said that they need a track record over 5 years. What can a young investor with no track record do to make them worth betting on, in your opinion? If there is anything they can do.
There's two good angles for someone to take who's young. One, hit up your friends and family. They're most likely to invest in you. They know you well. The second thing is to bring out in an outside third party experienced investor. I'm more willing to give it a shot with you, Jose, if I know one of the people I trust is going to be a joint venture partner who's looking over his shoulder, who has experience with that, and then do that for enough years until you get your own following, and then go out on your own.
It's good. So you've made so much money, millions of dollars. What mindset separates someone who builds wealth fast versus someone who just stays stuck?
Don't be afraid to pivot. I would say it depends on what your priorities are. I could have made a lot more money if I had done real estate longer and not pivoted. So in my exit in 2016, 2017, there was a major life shift for me where I realized I had a lot of clients that had an extra zero behind their name on a net worth statement. And more money doesn't necessarily make you happier. And so I had a reprioritization of saying, today where I'm at, I'll go hard from about 8:30 to about 4:30 each day, but then I'm done. I did the long hours especially at Deloitte, 80, 100 plus billable weeks and consistently, and I wasn't happy, wasn't satisfied. And so at some point, the money doesn't matter as much. When you're young, that's the best time to strive for it. But it's taking a step back and building a lifestyle business. I have a nice house. I don't need the private jets. I'm sure I could upgrade my countertops, but what would an extra $1 million do for me now? It wouldn't materially change my life right now. And I'm fine with that. I'm very present with my family and my kids, and that brings so much more joy than more dollars could. So it starts with, what do you care about? What do you prioritize? I would say get clear on, if you're trying to reach work optional, then get clear on that number, whether it's 10,000 a month, $100,000 a month, $1 million a month. At some point, there's a number that will probably provide everything you need. Have some buffer, maybe double it, but once you get there, maybe slow down. I know the people who have the $1 billion net worth, and often they're playing the game. They do wealth because it's fun for them. But at some point, the money doesn't really matter anymore, unless maybe you're trying to give it away or have this big impact. And that's why with everybody we work with, it starts with your vision, your core values, and then we can reverse engineer the wealth to get you where you want to go.
So you talk about being work optional in 3 to 5 years. What does that really mean, and how did you personally do it?
Yeah. So most people, you talk to an entrepreneur, a business owner, the idea of retirement sounds boring. Like they don't know what they would do with their time. And so we've really shifted so when I reached retirement at like 32 and people are traveling, like, what do you do? Nothing. Like, I'm retired. It was like a joke. And so there was really a mindset shift of a lot of these high performance people like the option to work, but they don't want to have to. And it provides optionality. My personal journey looked like buying the flips, the rentals, the owner finance, the wholesaling, like all sorts of creative stuff in real estate, into hotels and apartments. And then as a CPA, I knew who the best performing syndicators were. I placed money with a group of them, and that worked really well until about last year. 2024 was a tough year. I've been learning a lot. Happy to expand on that. But all that to say, we had more than enough passive income coming through all the real estate deals to fund our lifestyle through 3+ years of 4 to 5 star travel the whole way. And it was fun.
So tell me about 2024. Expand on that.
Yeah. So 2024 interest rates went up, and a lot of commercial real estate deals stalled out. Or I felt like I was doing reverse investing, meaning there were capital calls and I had to put money in to keep the deals afloat. We had this unique cycle from 2010 to 2024 where real estate was cheap and interest rates were coming down. So there was this really upward pressure that allowed real estate to grow, even if you made dumb mistakes. So a lot of syndicators felt almost got overly prideful and arrogant, thinking I can just touch anything, it makes money. But a big part of their success, a lot of business owners, investors don't want to admit this, but luck also has a big factor to it. And the fact that even if you managed a property poorly, because interest rates came down, that meant new buyers at a lower interest rate could afford to make the numbers work at a higher purchase price, meant that people consistently pay more for these properties. And so they did. And that meant sellers could consistently sell, even if they were poor managers, at a higher price. 2024 had us seeing like this real estate bubble start to deflate. And thankfully, it was not this giant cliff like some had feared. It's just been that a lot of investors have been working through stuff. I know I've had a few things that have gotten foreclosed on that I was invested in passively. Some things that I think were the fault of the syndicator for not paying attention, not being a good operator. And there were some things that it was just the fault of the market. They couldn't refinance. They were operating as well as they could. So really what that shift in us has been is we need more liquidity. And so one of our rules is you need at least 30% liquidity across your portfolio, one, to live off of if you're doing. Secondly, if you're in a capital call or you need to put money in to keep a deal alive, you've got the option to because you've got the liquidity. Initially, I kind of swore off all stock investing because it's not really something I could control. And I know a lot of people have had success. I really like the private investments because we've gotten phenomenal returns in the past. And so since then, we've expanded to oil and gas. We've done a range of private equity options outside of real estate to kind of fill in the gaps. And then on the liquid side, I just finished a 2-week trip around the world where we were presenting to different, we were hearing presentations from either hedge fund managers, family offices, stock pickers, newsletter kind of guys around. And then the best of those presenters were invited to the Oscars of Creativity at our event in Dallas. So October 24th, passiveinvestorevent.com. We're inviting those people in. These are our favorite speakers. One of the guys used to manage the money for the Rothschilds for 25 years. And so you start bringing those caliber of people in, you're seeing unique opportunities to invest in stocks and earn a above index type return. And it's a nice way to round out the portfolio.
So for people who want to invest, what would you recommend they do? Because right now I'm saving up for a down payment, and all I really do is just invest in stocks like the S&P 500. Is there any alternative option you would recommend?
Ooh, so if you're going to go down the stock rabbit hole, find a couple of people you really trust that are maybe great stock pickers. You could read Substacks. Like that's a rabbit hole to go down. Not a bad one if you're wanting to manage liquidity. Even one of my clients that has a ton of apartments, she manages a rather large 7 or 8 figure sum of stocks, does covered calls and some other things, and is able to earn a 12% return on that. She has to have that liquidity for banking reasons with all these big loans. And that's a way to earn a significant return. If you're really getting started out and you want to grow wealth quickly, invest in something you control. That's where you're going to get the highest bang for your buck. So it can start off in real estate, do your first couple residential deals, but as soon as you see an opportunity to get into commercial, that's where we add a 0-2 behind everything you do. That initial rental deal, you're going to learn about closing, title companies, things like that. Things in commercial are slightly more complicated, but if you could do 100 rental houses, and that would take a lot of time and effort, or you could do one apartment complex, which is still a lot more effort than one rental house, but not the equivalent of 100 rental houses as part of that. So scale up quickly. And it could also be whether it's starting your own business, don't be afraid to start a side hustle, try things that resonate with you, and you own your success or failure when it's just you. And now's a great time to take some risks especially when you're young.
So I've heard a lot of people talk about 1031 exchange, putting all your rental properties into 1031 exchange for like an apartment complex. Could you explain to me like how that process is?
Yeah, that makes sense if you're going to own and control and not have a ton of other investors. There's a lot of misnomers about that. So you can package things up. You can do 1031 exchanges. In essence, you're really just deferring the taxes. And if you're going to defer all the way until you die, assuming estate rules don't change, you can receive the step up in basis and thumb your nose at the government and never pay taxes. I've had a guy who was buying duplexes in Chicago in the 60s all the way up until it was like, I think it was 2008 when he passed away. I was preparing his tax return then, and he it was like a really large, like 8-figure kind of gain that his heirs like were able to get helped out with because of that step up in basis. If we're doing multiple single family houses, you can package them up, you can put them together into that larger property, that apartment complex. Most syndicators are willing to do it once, then realize how complicated it is to receive third-party investor money through that. You can typically only do another 1031 exchange from one apartment complex to another as long as 50+% of the investors decide to continue on with that 1031 exchange. And so if you got multiple investors that aren't related, it becomes really messy quick because inevitably somebody wants to sell and not continue on because people have their own needs. One of the best ways to get out of that, if you're familiar with opportunity zones, that's going to get a refresh on the legislation likely for 2026 or 2027. And that's a great way to roll multiple 1031 properties into something. And then you get the best of a 1031, but a much greater upside in that your capital gain of the new activity is never taxed.
So where should someone start if they want to make work optional in the next 3 to 5 years?
It depends on where they're starting. If you're young, I would start with a business or start with real estate and grow from there. Most of my clients have an existing business or assets. And when they come to me, we're often just repositioning existing assets. So one of the calculations we will do is what is your lifestyle number? Maybe that's $20,000 a month. And then we can do what do you expect to earn? 8%, 12%. And we can do that math, that inverse of 20. What would it take you at a 12% return to earn 12,000 a month? And I think that's about 2.4 million or so. And then we add in an inflation number as well. And so if your net worth is currently 2.4 million above, we just need to optimize your existing assets. And there's a process that we can go through that to help you do that relatively quickly. If you don't have that number and you're initially earning your wealth, then we really need to focus on growing either equity, growing investments, things that will increase your net worth. And it depends on what you're starting with. So if you have your first $1,000 and you can earn an amazing 20% return, 20% on $1,000 is $200. You're probably better off focusing on your job, career, starting a business. But if you've got $1 million net worth and you've got a 20% return, focusing some time and attention on wealth as the business means that 20% return can yield much stronger results because that's $200,000 a year. And you can roll up the math from there based on your net worth.
Let's go back to the house hacking part.
Yep.
Say someone wants to get started in real estate and they want to do house hacking. Which method would you recommend more? Because I know you can rent out the other rooms, or you could get a multifamily and rent out the other units. Have you done this before? And if you have, which way works better in your opinion?
No, no, candidly, I've never house hacked. I'm familiar with it. I know usually when we talk about it, it's for like a college student attending university, helps you choose your friends more wisely, or at least your fellow tenants, because if they're tearing up the house, you probably don't want to deal with that. You've got some ownership. You care more than if it's a third party rental house. Um, I think it's on a single family house, you're typically going to have more appreciation of the value of the house over a period of time. A quad or like a 2 or 4 unit place, you're going to have likely more rental income, but less appreciation on the value of the structure itself. And so it depends on what you're looking for. If you're trying to free up your time where you don't want a job, then maybe you're going more for the duplex, fourplex. The single family house is relatively simple. There's usually less tenants, but you got more appreciation on the backside.
If you could go back to whenever you first started real estate and give yourself a piece of advice, what would you say?
What a great question. Get into commercial real estate sooner. I thought I was too young and dragged my feet, and not that 2013, 2014 was all that long, but I doubted myself, and frankly, I could have done it after a year or two. Um, if you're a part of a group, I mentioned Lifestyles Unlimited just because that's what I've done, but there's all sorts of RIAs and different groups out there. Find a group of people who can invest, somebody that teaches you how to do it, or a group of friends is probably the cheapest way to do it. Find some people that have either done it before, work with them, find a way to add value. For me, my entrance to a lot of this was the taxation and the accounting. I had a very niche skill set that almost everybody needed, including those much more successful than me, and it got me a seat at the table. And then from there, just try to do your first deal. Sometimes things fall apart. Try not to put money down until you're absolutely certain things are going to work out. Especially when you're young, your capital is so precious. You want to really protect it, and you've got time. Later in life, you're more protective of your time and less protective of your cash because you've got more cash.
So you would recommend real estate investors get into commercial like as soon as they can?
I would say yes. Do your first deal or two, but then find somebody, do a deal, or it doesn't even have to be real estate. It could be oil and gas. It could be any sort of investment where you get a piece of the equity. The overall message to anybody is find a way to get an equity in something. Find a way to add value that entitles you to it, whether it's you starting something or adding so much value to somebody else that you get that.
So tell me what's next for you. What are you building now?
Oh man, the big thing that we're about to launch is called discountedrollovers.com. You're familiar with a traditional retirement account?
Like a Roth IRA?
Yep. So there's traditional and then there's Roth. So traditional is pre-tax money, Roth is post-tax money. This is money, how to move money from a traditional to a Roth at a 30 to 70% discount. So there's nobody mainstream nationwide doing this. And so let's say you invested $100,000 into an operating hotel that we're going to convert to an apartment complex. Day two, we shut down that operating hotel. What is the shutdown hotel worth? A whole lot less than you paid for it. So we come in, we do an independent valuation. And for those familiar with estate planning, we stack on lack of marketability, lack of control discounts on top of that. And we're often getting a 50 to 60% discount on that rollover. We reopen the property as an apartment complex maybe a year later. And now the value is maybe worth $200,000. Earlier, when things were shut down, we got that valuation. It came in at maybe being worth $50,000, your investment. We do the rollover of the asset, not the cash. We pay taxes on the $50,000, but then it's never taxed again because it's in the Roth and you've got $200,000 in that account.
That sounds pretty cool. Can't lie. So where can people find you, follow you, and learn from you?
Sure. Thanks for the question. Financialjourney.life is my website. If it makes sense, we're doing a big event, passiveinvestorevent.com. Love to meet some investors out there. You're going to hear all sorts of private investments. It's a place to meet investments, professionals, mastermind groups, have some fun all in one place. It's at the in the Dallas Fort Worth area, October 23rd.
Thank you. That's all I got. Thank you so much for joining me. I really appreciate it. And I hope we can connect in person sometime.
Thanks for hosting me, Jose.
Thank you.